Hi all, welcome to my YouTube channel Banking Regulation Simplified. In this channel, you will understand the latest trends of banking regulation, understand in-depth concepts of banking regulation, and also you can use this YouTube channel to catapult your career in the world of banking regulations. Good luck. Hi all, welcome to another video on our channel Banking Regulation Simplified. In today's video, we will talk about credit risk, which is one of the major components of risk under the Basel framework. This will fall under the Pillar 1 output. And if you are probably working in a bank and regulatory reporting, you will know the amount of credit risk each bank entails through the course of their business model. Credit risk is one of the first component introduced under the Basel framework under the first version way back in 1988. So in today's video, we shall see the journey of credit risk, its evolution, and how it has become sophisticated or complicated over the last few years, and the various methodologies and how the various RW parameters, the inputs on the various RW parameters have changed until the latest version of Basel, which is Basel 4. Okay, just in case if the video is not clear, I shall attach a copy of the slides towards the end of this video. Now let's get into this video. So these are the contents of the video. Credit risk, exposure at default, credit conversion factor CCF, standardized method of calculating credit risk, internal rating based IRB method of calculating credit risk, IRB capital formula, IRB calculation. So for the playbook, so formal definition of credit risk, but for us for simple understanding, credit risk is the risk involved of default on any lending you do as a bank for your customers. In other words, if you are giving a term loan, or probably if you are issuing a credit card to a customer, the money withdrawn under either the term loan or the credit risk is always having a risk of default by the customer, irrespective of the economic conditions, irrespective of the credit quality of the customer. Okay. This is the fundamental rule or the thumb rule of the field of credit risk or the domain of credit risk. But how will you translate that risk into quantifiable measures or into real numbers? That is where the methodologies and the various formulas come into place. So these are the various types of credit risk. Default risk, when a borrower fails to make payments on a withdrawal or on a loan obligation. Settlement risk, when you are involved in the settlement of risks, settlement of securities or derivatives, there is always a risk of the other counterparty failing to meet the settlement, either by giving the required securities or by paying the required amount. That is known as settlement risk. The third is counterparty risk. So if you are involved in the stock market or any kind of trading activity for derivatives or interbank transactions, there is always a chance of that counterparty going default and in turn not being able to honor the commitment for you, which could be in the settlement of the stocks or in the payment of the amount due. Then concentration risk, too much exposure to a single borrower or sector. This is at the moment this is being tracked, but there is not minimal stress or concentration importance given to this. But at the heart of it, concentration risk addresses that any bank should not be overly addressed to any sector or any specific set of companies, which would be good when things are good but would become worse when things go bad, because that particular sector or a group of company, when they are going is bad for them, that will in turn affect the fortunes of the bank. So these are the various types of real world examples, simple but real world examples. So whenever there could be instances where a good customer who has been regularly repaying the loan could default on one or two payments, or probably default for the remaining tenure of the loan. A credit card customer defaults on his monthly dues. So the first two are examples of similar scenario, but the customer profile varies. This is for a corporate customer, this is for a retail customer. And a counterparty bank fails to deliver securities after repo transactions. So we know repo, reverse repo is indulging in transactions for on securities, government securities predominantly for market related activities. So if they fail to deliver securities after repo transaction, that is an instance of settlement risk, which is a subset or a subcategory under credit risk. So if I were to picturize the pillar one components from a risk calculation point of view, it is credit risk, market risk, and operational risk. Under credit risk, there are predominantly two types of calculation. One is standardized, the other one is internal rating based. Internal rating based is having two separate categories: FIRB, foundational internal rating based. Second is advanced internal rating based. The formula for it is simple: EAD, which is exposure at default, or in other words, the amount of money which is at stake, which will include both the principal and the interest component, and RW, which is specific to the risk profile of the customers, depending on the financial health, depending on the of the customer, depending on the performance or health of that particular sector in which the customer operates. All this contribute to the RW or risk weight parameters. The output is known as the risk weighted asset. So at the beginning of the video, I had told how the probability of default on payments or on dues can be quantified into measurable format, which is being done by credit risk. Then this is the formula you need to understand or need to remember: EAD, exposure at default, into risk weight RW equal to risk weighted asset RWA. Now let's get into further details. So exposure at default is a key concept. Without it, if you go back to the previous slide, without it nothing can be derived. So that's the first point or the starting point. So if the total value of a bank or lender is exposed to when a borrower defaults, that means if they suddenly stop making their payments as per the agreed conditions, then that would account or qualify as a credit risk incident, meaning whatever would be the principal outstanding and the interest outstanding at that particular point of time post the default would be considered as the EAD or exposure at default. So it has two components: on balance sheet or off balance sheet, and off balance sheet. On balance sheet is simple: the amount of money that has been withdrawn by the customer. For all kind of lending products, there will be a limit set by the bank based on the risk profile or the financial profile of the customer. Let's take a simple example of a credit card. We all have, let's say a person has a credit limit of 1 lakh rupees and he has already used around 50,000 rupees, meaning the on balance sheet component is 50,000 rupees and the off balance sheet component is 50,000 rupees. Okay. Now that person, that particular individual, is on the verge of a individual bankruptcy or a personal financial crisis. So he may not be paying the interest, the credit card bill regularly, but at the same time he has access to use that 50,000 rupees which is available as unused balance on his credit card. And there is a high probability of a person facing a financial crisis or a personal default, using that unutilized amount on a credit card. So there is always a chance of that being utilized when a customer is in dire straits. So that 50,000 rupees in this example is the off balance sheet component. Now if we have to quantify that into credit risk terms or in terms of EAD, that is where there is another component to this EAD, which we shall see in the next slide. This component is known as credit conversion factor or CCF, giving an indicative value of how much, attaching a risk value to the unutilized part of the credit card or the available limit. Okay, so this CCF is given both by the supervisor and also derived by the bank depending on the methodology in which they are operating. And the off balance sheet component into CCF becomes the equivalent of an on-balance sheet component, or in other words, is added to the EAD. So in this example, bank gives a borrower a term loan of 50 crore and a credit line of 20 crore. So this 50 crore is already drawn. This 20 crore, 10 out of this 20 crore, 10 crore already used and 10 crore undrawn. So net, if you see in this example, the on-balance sheet component or the used limit of the used amount of the customer is 50 plus 10 crore, which is 60, and the unused or undrawn credit line is 10 crore, and which has a, let's take an example of CCF of 75%, meaning 10 crore into 75% will be 7.5 crore, and that 7.5 crore needs to be added to this EAD. So the final EAD is 50 crore plus 10 crore plus 7.5 crore. For conceptual understanding, the formula is current outstanding, which is on balance sheet, plus undrawn commitment into CCF. Undrawn commitment is off balance sheet component into CCF. This CCF, which is credit conversion factor, is given either by the supervisor or derived by the bank, which we shall see. Okay. So exposure at default. Now we are getting into slightly more details on how the EAD is getting derived depending on the methodology. So at the beginning of the slide, one of the previous slides, I had told the methodologies under for credit risk. Either it is standardized and IRB. Under IRB, it's FIRB and ARB. So if the bank is following standardized method for calculation of credit risk, then the credit conversion factor is given by the regulator. So in other words, the EAD will have always two components, on balance sheet and off balance sheet. The on balance sheet is the withdrawn amount or the used amount or the book value, and the off balance sheet is the unused or undrawn limit into CCF, and this CCF factor is given by the regulator if you are under standardized method. So Basel III typically, these are the typical CCFs under Basel IV given by the supervisor. If the commitment or the facility or the loan product is of tenure less than 1 year maturity, it is 20%, meaning the outstanding is around undrawn is 10 crore, 20% of 10 crore will be 2 crore, which has to be added to the EAD. Similarly, if the commitment tenure is greater than 1 year, the CCF is 50%, meaning if the undrawn part is 10 crore, CCF of 50%, the off balance sheet EAD will become 5 crore, which needs to be added to the EAD. In other words, the thumb rule in credit risk calculation is the longer the tenure, the higher the risk. So that rule applies even for facilities or for any kind of product. So in this case, if it is lesser than 1 year, the CCF is 20%. If it's greater than 1 year, the CCF is 50%. And unconditionally cancelable credit lines, like overdrafts with some conditions, credit cards with some conditions, meaning if the bank were to get an idea or get an information that the credit quality of the customer is deteriorating and he can use these undrawn limits for his own good and probably default on the entire amount, so then banks can cancel those limits and notify the customer. They do not have to take the approval of the customer before cancelling these instruments or these loan products. So in those conditions, for those kind of products which are called as unconditionally cancelable credit lines, the CCF is 0%. The next is exposure default, internal rating based. So in this, like we saw the various categories: maturity less than 1 year, maturity greater than 1 year, then unconditionally cancelable, and we saw examples of 20, 50, 0 given by the supervisor. In this scenario, this CCF percentage is derived by the banks which are on IRB, internal rating based methodology, through statistical models. These statistical models are built on historical drawdown behavior. For example, some corporates tend to draw 80% of available limits before default. Banks can model that. In other words, banks would have been in the business of lending and would have seen a lot of defaults. And when those default happens, there will be a pattern or a sequence of activities which will be proceeding before the default. which will be like on and off defaults or excessive usage of their available credit limit, or probably some impact, bad major impact, adverse impact to the operating sector of that bank, that customer. There could be many reasons. So but when these scenarios or these forecast inputs can be are used for the calculation of credit conversion factor, then banks need to mimic or get the inputs of these behaviors or scenarios into as inputs for statistical models. So this is where the field of risk modeling comes in, which is one of the most in-demand skills and toughest domain to crack. In one of the later videos, we shall see have an overview of what are the skills required for the field of risk modeling. And under IRB method, apart from CCF, there are multiple parameters which are required by banks for calculation of the RWA, and all of these inputs are derived based on statistical models which are built by risk modelers or risk modeling teams. So Basel defines two IRB variants. One is foundational IRB. So in this, there are four parameters required for calculation of RWA under IRB methodology. First is probability of default, loss given default, then EAD and maturity. We shall see each of these parameters in slight details in the upcoming slides. But now, with respect to the CCF part or the IRB parameters, if a bank is under foundational IRB, it will estimate only the probability of default, and the regulator would provide the loan given default and CCF. And the EAD is based on the supervisory values for the CCF part. But when the bank is on advanced IRB method, the PD, LGD, EAD all can be used derived by the bank itself based on the statistical models they have built. Of course, these models are subject to regulatory scrutiny and approval, and IRB model is widely adopted or followed in the European Union region and the UK region for most of the major banks in that region. And it's one of the toughest components of the risk modeling field, and which will fall under the credit risk subset. And aside to that, this is the operating place or operating ground for risk modelers. These parameters PD, LGD, EAD, CCF, which we shall see in the upcoming slides. Okay, so now this is a snapshot of exposure at default. If a bank is under standardized method, the regulator will set the EAD. If it's under IRB, it will have its own models for deriving the CCF, which will mean the off-balance sheet component will be calculated based on the CCF derived by the bank. On balance sheet, book value, because that is ultimately the amount which is used. And off balance sheet, fixed CCFs 20%, 50%. Estimated CCFs, meaning the CCFs which are estimated or calculated by the statistical model of the banks. Then risk sensitivity, it's very conservative because the inputs are given by the regulator. The risk sensitivity is high because banks take on or latch on to IRB model because of the lower outputs for EAD, RW and capital based on the inputs modeled under the IRB methodology. So it's high risk sensitive, and it's one of the failure points or one of the weak links which put a bank to shambles during the 2007-8 crisis. Okay, in other words, it's a credit conversion factor is a regulatory multiplier used in bank to convert off-balance sheet exposures into an equivalent on-balance sheet credit exposure. If the banks are under standardized or FIRB methodology, it is given with the regulator. If they are under AIRB, it is derived by the bank based on statistical models. So, for simple understanding, if a customer were to default, at the point of default, how much of that unbalanced or unused limit or outstanding limit which is unused on the instrument or in the loan product is at risk or probably will be used by the customer and will be defaulted later. That is where credit conversion comes into place. And in other words, credit conversion factor is at the interjunction of modeling human behavior and statistical models and giving it as a quantifiable output for calculation of credit risk. Why is CCF needed? So this is a repetition of what I had just told. So we'll never be able to know or understand what really is happening at each customer level. The customer behavior is more of the uh, uh, factors pertaining to the individual customer preferences, financial health, and the overall economy. So which will prompt them to lend, borrow, and if things are not good at a personal level or at a national level or at an economic level, then the customers may be forced to default, which for reasons which will be beyond their control. So all this will mean banks are facing a risk which is of two categories. One, they will lose the existing outstanding and the existing interest payment or interest outstanding, plus whatever amount of credit which can be used by the customer for their own benefit as per the earlier agreed timelines, that also can be used and subject to default. So which will mean that is a higher or a additional layer of risk over the existing layer of credit risk in which they are operating. It is subject to many conditions. So that is where CCF comes into place, giving another tangent or adding another input or additional values to the calculation of credit risk. So this is what we just saw. EAD equal to drawn amount plus undrawn amount to CCF. EAD exposure at default. CCF is credit conversion factor. So these are the, like we saw earlier. So these are the CCF buckets given by the supervisor. Unconditionally cancelled with 0%. Less than 1 year is 20%. Greater than 1 year is 50%. For certain guarantees, standby letter of credit and other fully binding obligations which need to be honored by the bank irrespective of the economic scenario or the financial health of the customer, then that qualifies for 100% CCF, meaning whatever is the undrawn limit or unused part will be fully calculated or fully factored in under the calculation of EAD. So this is example. So term loan 50 crore, unused credit limit 20 crore, maturity greater than 1 year, CCF equal to greater than 50, CCF is equal to 50%. So we need the unused limit into the CCF, which will be 10. So already there is an outstanding of 50. So 50 plus 10 is equal to 60 crore. Though 50 crore is only drawn, regulators assume another 10 crore can be used by the customer when things are really bad for them or they are in dire straits. So that 10 crore also needs to be factored in calculation of the EAD, and this will be factored in when RW and capital is also calculated. IRB approach. So the CCF is prescribed by regulators in standardized, but in advanced IRB they can use their internal advanced estimated CCF based on historical data, which are the outputs. These historical data go as inputs for statistical models, and the CCF is an output of those statistical models. The CCF is a factor applied to off balance sheet to tell how much would be the actual amount or closer to actual amount or real exposure at default at the time of a default. So credit conversion factors under the three methodologies. So for, like I said, standardization foundation, it's given by the regulator. IARB, banks can estimate for various categories: unconditionally cancelable, less than 1 year, greater than 1 year, direct credit substitutes, contingencies, issuance, and derivatives. So if you see for all these categories, it is the same between standardization and FIRB. For advanced alone, they can model. For derivatives, where the methodology slightly differs, it's more or less the same, which we shall see in one of the later videos where we cover the calculation methodologies for calculation of EAD and RW for derivatives. So takeaways: CCFs are fixed by regulators, simple, conservative. Foundation given by the regulators, advanced, used by derived by banks based on the statistical models. It's highly risk sensitive and data intensive also. So CCF is static and standardized in FARB, but dynamic and estimated by banks in ARB. And this is of course scrutinized and approved by the regulators, and also subject to regular scrutinies by these regulators. So CCF illustration, whatever I've just spoken over the last few slides, I put it as in a pictorial. So how CCF will work if the bank is under standardized. Loan amount of 10 crore, drawn is 5, undrawn is 5. So EAD of drawn amount will be directly going. Undrawn amount, it's less than 1 year, so CCF is 20%. So 5 crore into 20% is 1 crore. The EAD is 6 crore. So this will be the output of EAD if the bank is under the standardized or the FARB model. Now let's see the output under the ARB model. The difference is, the CCF is at 12%, meaning 5 crore into 12% will be 0.6 crore. The actual EAD will be 5.6 crore, meaning under the earlier example where the CCF was 20%, which led to a final EAD of 6 crore. Under the ARB method, the CCF is 12%, which is lesser than 8%, and the final off-balance sheet component is 0.6 crore. This is less than the 1 crore which is calculated, so lesser by 40%, which will be directly included in the EAD component. So under the standardized method, the EAD was 6 crore, but under the ARB method, the EAD is 5.6 crore. So in percentage terms, it's a savings of 10% for the bank for calculation of EAD when they use ARB models. Internal rating method. So like I said, this is a risk sensitive framework for calculating the minimum capital, and has many parameters, complicated and sophisticated models. Statistical models will calculate and give those parameters, and those parameters will be used as inputs for regulatory prescribed formulas. So this is at the cutting edge of statistics under risk modeling, and one of the highly valued and high demand fields, and requires a lot of expertise to be a risk modeler. So these are the risk parameters in IRB. First is PD, probability of default, meaning what is the probability or likelihood of a borrower defaulting. Next is loss given default, provided the default has already happened, then what is the amount or value at stake or at risk. This is an output of LGD, which is given as a parameter. EAD, so we already know how much is the amount which is at stake, which will be sum of the principal plus interest payments plus unused component. And maturity, effective maturity of the exposure. This, like I said, the thumb rule in credit risk: longer the tenure, higher the risk. So this will also be used as a parameter for IRB. So these parameters are used in Basel prescribed formulas for calculation of RWA. So if a bank is under FARB, banks can estimate only PD. Regulators will provide values for LGD, EAD, and maturity. If they are under ARB, they can model all these values: PD, LGD, EAD, and maturity. So these are the various regulators for the major jurisdictions: RBI in India, ECB in Europe, Fed in US. They must approve the usage of IRB models by a bank. And like I said earlier, IRB models are widely used by the major banks operating in the European Union and the UK region. So this requires historical data. The model scrutiny for IRB model requires historical data on defaults and losses, robust validation of models, independent risk control and audit, and they are restricted only. They are not restricted only for regulation, but can also be used for internal decision making, meaning the RWA is used RWA and the subsequent capital allocation will obviously impact the profitability or the margins for each customer, and the output of IRB can be used for, meaning the output of IRB will reduce the outputs for RW and capital for a bank use compared to a bank which is under standardized method. So this will obviously give an advantage to a bank under ARB method. So when there are an advantage through lower RW and lower capital, then they will have an additional pricing power through which they can offer better rates and better pricing options for a customer. So this is one of the key benefits when a bank is under ARB method, meaning the output is lesser, meaning they need to set aside lesser capital if they compared to what they would have had to do when they have under standardized model. So that lesser output mean more margins for them, which through which they can offer better options, better pricing models, and better rates for a customer. So which is key to competitive edge in the space for lending or in the core business of lending for banks. So advantages, it's more of IRB. So it's more risk sensitive, rewards banks with better risk management, lower capital, encourages uses of quantitative risk measurement, which is nothing but statistical models for measurement of our risk parameters. The challenges or criticism, data and resource intensive. Like I said, it's one of the highly valued and much touted field, but requires a lot of expertise both at an individual level if a risk modeler, and a lot of maturity and process maturity and expertise as an organization also to adopt IRB, because ultimately it means scrutiny and approval by the regulator and also subject to regular scrutinies. Model risk. So the statistical model complexity, yes, they are complex. Like I said, statistics is complex, lot of inputs, lot of outputs, and but this is being under a lot of regulatory scrutiny. So there is a check kept under Basel IV for IRB methods, which is known as capital floor, which we have seen in our earlier videos on Basel IV. In other words, whatever is the output of a IRB model, that should not be less than 72% of the output of a standardized model. So the challenge, the advantage or the benefits which are enjoyed by banks which had adopted IRB will slowly fade away when things move under the Basel IV regime or Basel IV Accords. So this is the IRB capital formula. So I've just kept it here. This requires a lot of understanding and learning, but we are slowly getting into concepts and things. So for conceptual understanding or for the record's sake, I kept this here, but this formula needs to be broken down further, which we shall do. So the IRB capital formula, explanation of various parts: capital requirement as percentage of EAD, PD, probability of default, LGD, loss given default, EAD, exposure default, maturity, asset correlation, inverse of standard normal, G is inverse of standard normal, N is standard normal, D is maturity adjustment factor. So asset correlation, this is the formula. So this formula in itself has a lot of concepts which we shall see. Similarly, maturity adjustment. So like I said, this maturity increases for longer tenure loans, and is lower for shorter tenure loans. So that factor of higher risk for longer tenure is taken care through this subset formula. And this is the final part. So RWA is 12.5% into K into EAD. So we already saw what is K in the earlier slide. This is the formula for K, and this is the breakdown of the various components of K and the various subsets under K. And RWA is 12.5 into K into EAD. So this final formula is simple, but we all know this is component of on balance sheet and off balance sheet with EAD, and K is a complicated formula. Ultimately, the capital requirement is 8% in RWA. That's the bare minimum. Then we'll have a lot of buffers like capital conservation buffer, counter-cyclical buffer, GSIB buffer, which will be topping up over this 8%, meaning the final capital requirement for a bank could be anywhere between 12 to 16% of RWA. So this is a high level example of how the inputs are translated into formula outputs, and how these formula outputs are finally translated into capital output. This attachment has the workings, but in this video I'm not getting into the calculation, but in one of the later videos I shall explain this calculation. So that's a sneak peek about me. So we have come to the end of this video. So like I said, this has been a phased journey where we got to understand the industry or the domain of banking regulations and the various organizations behind it, and how the Basel Accords, the key regulations for banks for regulatory compliance, have evolved from Basel 1, 2, 3, 4. And now in this video we got to see how credit risk is calculated and reported for banks. So we got to see the formulas at a high level. In the one of the subsequent videos, we shall get into the formulas and also get into real calculation and how this is being reported. So that is part of the the phased journey which has been going on for the last few months. I hope you like this video, and like I said, a copy of the slides will be attached towards the end of this video. Please do share, subscribe, and like. Thank you. Good luck.